Welcome back to our breakdown of Michael Saylor's keynote from Cantor Crypto 2025, the talk that's shaping the way executives, investors, and entire nations think about capital. In part one, we explored the rise of Bitcoin as a political and economic force. Today, in part two, we're diving into what might be the most important idea Saylor has ever introduced publicly. Bitcoin isn't just money. It's digital capital, the first new form of capital humanity has created in over 100 years. Saylor connects this to global inequality, artificial intelligence, corporate governance, and even the survival of companies themselves. And at the center of this entire segment is a brand new concept, the Digital Treasury Model. A business model that didn't exist before Bitcoin. It might become the dominant model for corporations over the next decade. Let's listen now to the next section of Michael Saylor's speech.
So that observation, Bitcoin is digital capital, is key. We are capitalists. The capital assets of the 20th century, equity capital, real estate capital, credit-based capital. Most of the world thinks private equity, public equity, and real estate is primary capital. The emergence of digital capital is pretty profound because it represents an alternative to people who don't perhaps want to store all their wealth in real estate. As I've said before, there's really no real estate in Africa you probably want to put your family savings into for the next 100 years. There are lots of parts of the world where people just don't want to store their economic energy for long periods of time. So the emergence of digital capital is a global phenomenon. It's also a political phenomenon. It's also a technical phenomenon. And of course, if you pair the emergence of digital capital with the emergence of digital intelligence, you can imagine that in a world with a billion AIs talking to a billion AIs a billion times a minute, they're not going to have a lot of patience for 20th century ways of doing things. They're not going to buy sports teams. They're not going to buy fiat sovereign debt capital. They're not going to store their money in cash. They're not going to trade gold. They're not going to want to store their capital in buildings or cross-trade commercial real estate. They're certainly not going to be comfortable with securities and all of the human and legal and political restrictions that come with them. So the emergence of digital capital at the same time as we have an emergence of digital intelligence is maybe it's a coincidence, but maybe it isn't a coincidence. Maybe it's an inevitability. So the second point I want to focus on is the emergence of the treasury model, of a digital treasury model. What is it? A treasury company is a company that sells securities to buy a commodity that it then capitalizes on and then issues credit against the commodity. So if you sell securities, raise capital, and then issue credit against the capital, you've created a treasury company. There traditionally haven't been a lot of treasury companies because the SEC 40 Act prohibited publicly traded companies in the United States from capitalizing on securities portfolios. Everything that I'm going to describe you could do with the S&P index or a portfolio of Magnificent Seven stock, except for the fact that regulations in 1940 put in place by the United States make it illegal. And so because you could never have more than 40% of your liquid assets sitting in securities, you find Warren Buffett's got to continually trim his position in Apple stock. He's got to sell his securities. He's always got to keep 60% or more of his liquid assets in treasury bills. And it turns out that most of these mathematical methods don't make any sense if you're using sovereign debt as your capital asset for economic reasons. So we inadvertently discovered a new business model. There's insurance companies, there's banks, there's all sorts of business models. This is a treasury business model. And how does it work? We sell equity, we sell credit, we sweep cash flows, we buy Bitcoin. We've done it 85 times. We found ourselves with about 3.1% of all the Bitcoin in the world. We spent $48 billion to buy it. It changes value every day, plus or minus a few $1 billion. Doesn't bother me, it bothers other people. I rather like it, I enjoy it. We've gone from an irrelevant company to the 5th largest treasury in the S&P index. You can see the chart. We'll be the number 2 in the next 12 to 24 months. I expect we'll be the number 1 in 4 to 8 years. There's only one company on this chart other than ours that has a practice of accumulating capital, and that's Berkshire Hathaway. Every other company on this chart has a practice of surrendering capital. And so one of the big ideas in the Treasury model is, instead of surrendering capital enthusiastically as fast as you can and bragging about it, you might want to keep the capital. Every big bank, every time they have a good quarter, they increase their dividend and increase their buyback as though that's an accomplishment. Every big tech company increases their dividend, increases their buyback as though it's an accomplishment. It's not an accomplishment to surrender your money, right? If you walked into your dining room on Thanksgiving and told your family that your idea to improve the family was you're going to give away all the family's money. That way we won't have a volatile balance sheet. It's not good for the family, right? I think intuitively you know that it's not a good idea for you to give away your money. And you know it's not a good idea for your family to give away your money. But somehow, somewhere along the line, the conventional wisdom in corporate finance is that money is toxic, capital is bad, and the most shareholder-friendly thing you can do is decapitalize the company by throwing all the money out. Now, of course, the irony is the best-run companies in the world are in the business of getting rid of money. And that leaves the investors to figure out what to do with the money that's being surrendered by the well-run companies, and there's a certain irony to it all. It comes about because they're all capitalized on the wrong asset. You can see here, in the last 5 years, the cost of capital is 14%. It's the S&P index. Turns out the gold is tracking it. You have two interesting capital assets: metallic capital, gold; equity capital, the S&P index. 14%. That's your hurdle rate. Money markets pay you 3%. Therefore, you're destroying 11% of your treasury assets every year that you hold money markets. Bonds are minus 4%. That's how you bankrupt your bank. The Mag 7's double that number. Bitcoin's double that number. Our company outperformed Bitcoin in the time frame. If your company is capitalized on an asset which underperforms the S&P, then you're negatively polarized to capital. It's toxic to you, so you're going to throw it away as the rational thing. If you're capitalized on a product like Bitcoin that outperforms the S&P, you're positively polarized to capital. You attract money. In fact, the more money you raise, the more profitable you become, the more shareholder value you create. It's a very simple idea. Flip the polarity from negative to positive, and then you just get stronger every single year, and you'll get more powerful. But as you can see, right, the reason that you can't capitalize on the Mag 7 is the SEC 40 Act. And you can't capitalize on the S&P index because the SEC 40 Act. I guess in theory you could capitalize on gold. Interestingly enough, no public company has really done that. And the point that I make to the gold bugs is even the gold miners don't do that. And if the gold miners aren't doing that, then there must be an issue. I don't know what the issue is, but what I do think is the general tendency of corporations is you throw away your money to the investors, and the investors buy the index, and that's how they keep their economic wealth intact. And that's good for the investor, right? That's why Harvard Endowment and Yale and Harvard and all of these large institutions, that's why they have a 500-year life expectancy. They just buy a capital asset like real estate or equity. And the reason that your favorite company lives for 5 or 10 or 15 years and goes bankrupt is because they don't have any assets, right? It's like, again, I've said before, they're like type 1 diabetics, right? They can't store energy. Bitcoin is insulin. It's insulin to the type 1 diabetic, right? If you're a company you need Bitcoin. It's like your insulin. All of a sudden, you can store economic energy. You're not doomed to decapitalize yourself. Our company's raised a lot of money. We raised a ton of money via equity issuance, a lot of money by bonds, and in the last 12 months, we've really rotated to raising capital via preferred stocks and preferred credit instruments, and that has taken off.
So let's unpack what Saylor just laid out, because he just drew a map of the next 20 years. First, he explains that Bitcoin is digital capital, something entirely separate from equities, real estate, or credit. In a world where billions of people cannot safely store their wealth in land, cash, securities, digital capital becomes a lifeline. It's borderless, permissionless, incorruptible, and accessible to anyone with a smartphone. Then he pairs this with the rise of digital intelligence, billions of AIs talking to each other, making decisions at machine speed. And his point is simple. AIs won't store value in fiat debt, sports teams, commercial real estate, or gold. They will migrate to the most efficient, liquid, programmable form of capital, which is Bitcoin. But the biggest breakthrough in this segment is Saylor revealing the Digital Treasury business model. You raise capital, sweep cash flows, buy Bitcoin, hold, issue credit against it, and become stronger every year. MicroStrategy, now Strategy, they didn't plan it, they discovered it. They've had 85 accumulations. They own 3.1% of all Bitcoin. They have $48 billion deployed, and they transformed from a forgotten software company into one of the top treasuries in the entire S&P. Meanwhile, every other company on the chart is surrendering capital, bragging about buybacks and dividends like it's an achievement. Saylor says, if your capital asset underperforms the S&P, you're forced to throw money away. If your capital asset outperforms, like Bitcoin, you become a magnet for value. Flip the polarity, negative to positive, weak to strong. And his analogy is blunt. Most companies today are like type 1 diabetics, unable to store energy. Bitcoin is the insulin that lets them survive. In the next part of the series, we're going even deeper into this idea, including why corporations are structurally designed to collapse and how Bitcoin fundamentally rewrites that destiny. If this series is helping you understand Bitcoin on a deeper level, hit like, subscribe, and share this breakdown with someone who needs to hear it.